Hey, traders. Welcome to our non-farm payroll coverage here on the Simpler Trading YouTube channel. I know it's Good Friday, but this is a major economic event and one that I will be watching as a futures trader, as a currency trader. I'll be watching in terms of impact on macroeconomic expectation. Well, macroeconomic impact that will affect what we expect collectively from the Federal Reserve. Another thing to keep in mind with non-farm payroll, the strength in non-farm payroll over the past, I'd say 2 to 3 quarters it's been formidable. And with that, we have at this point, pretty optimistic earnings season that's going to really officially, if you will, be underway next Friday with the slew of bank earnings that are going to begin on, what is it, the 14th? So we have a lot riding on this NFP. And then once this is done and we can, step back and take a look at the data here on the target rate probabilities, I did want to, we're still a good, let me get the clock up here. I know I have my clock somewhere. There we go. We still have a good 14 minutes before this release, right? There we go. A good 14 minutes before this release. And the idea here is, what are expectations, not necessarily only for May. Let me make this a whole lot bigger. There we go. What are expectations not only for May, the May 3 meeting, but are we looking to hold or hike into June? Now, going into non-farm, this is 13 minutes before NFP. Take a look here. It's these types of measurements that are truly macroeconomic measurements. And by that, I mean, rather than look at headline to headline and presume this is how the Fed is going to react, or presume this is what traders and investors think, we go right to the Fed fund futures and the probabilities. Now, remember, the current target rate is 4.75 points to 5%, right? That's what this means. This is basis points. So if you put a decimal after the 4, you put a decimal after the 5, this is what you end up with. Well, as long as we're in this column, right, expectations are for, of course, a hold. Once we start moving up to the column that would represent a 1/4 point more, this, of course, is the hike. So if you've never looked at this data before, that's how it breaks down. We're just looking at probabilities. This is 45.5%. This is 47.5%. I'm not really worried about the 7% because this is a very minor, if not insignificant, expectation for a cut. But it is interesting that it exists. It is interesting that that's even something that's being discussed. And remember the important thing about Fed fund futures. Someone has actually traded the contract. It's not an opinion, right? There is money behind this opinion, which is why, even though this is a rather illiquid contract, it's really interesting because people have to place a bet on this is what they're thinking. All right, so then we move out to, so May, by the way, it's not right now before NFP. And by the way, if you're wondering, why do we care about jobs? This is why, right? What is it that the Federal Reserve is going to say and do based on this jobs number? This is the primary thing. Right now, there's almost a 55% expectation of a 1/4 point hike, gang, in May. So this whole idea that we're going to cut or hold in May, not sure. This, of course, is the hold, right? That's the hold in here. But we'll see what this looks like at 8:35, at 8:40. We'll be together until 8:45 here, gang. And then we'll take a 15-minute break and we will have a charts and coffee session today. You can just catch the other link here at the YouTube channel or at my channel at Raghee Horner. All right, so this is what we're seeing. Now, here's the big question. Let's go from May, June to a July, September conversation. Come July. Now, we don't know if we're going to stay at 4.75 to 5%, or if we're going to move up to 5 to 5.25. So all of this in July and September gets tricky because we're really not sure where we're going to be come May 3 or even June 14. But you'll notice that would still either be a hold. The second most probable, this would most definitely be a cut. Whether we're here or whether we're here, this is the second most likely probability in July is a cut. Now, gang, this is not about what I think they should do. This is not about what I think they may do. I'm not prognosticating here. I love when people say, oh, the Federal Reserve's not going to cut. Okay, right? Or they're going to keep hiking. Okay, right? I can't tell the future, but what I can read is what the data shows. When we have any kind of discussion here in Charts and Coffee or bonus trading sessions like this, or even in the Sector Secrets Mastery Room, I'm always looking at data, gang. I'm always looking at price, never opinion. There's a lot of folks out there staring into their crystal balls, telling you what they think, and at the end of the day, that really is nothing but opinion. We want to stick with the data. Please listen to me now, believe me later. All right. What do we have come September? Same conversation. Most likely probability is, by the way, gang, regardless of where we end up, this is a cut. That's a quarter point cut. Here's another quarter point cut. So come September, whether or not the Federal Reserve does this, believe me, they know that we are communicating to them. This is not reflective necessarily always of what we think they're going to do. Sometimes we're trying to tell them, this is what you need to do, because if you don't, there's going to be a tantrum that will ensue. Now, where are the other places we can look for evidence, right? Other than the Fed fund futures, that's actually a futures contract, gang. That from that, we're extrapolating what expectations are as far as where rates will be. What are other places we can look for rates? We can look at bonds, right? We can look at bonds. So let's take a look at the 30-year bond. This is ZB. Now, when I'm looking at bonds, we'll look at the 5-minute when we start to day trade the futures for NFP here in about 8 minutes. All right. But take a look at what's happening on the daily time frame of ZB. Now, let's look at a couple. I know I've got a lot of things going on here. All right. Let's look at a couple things. And I'm going to actually, for now, I'm going to just take the wave off the screen. Some of you might be familiar with the 34 EMA wave, the 34 EMA exponential moving average on the high, the close, and the low. There are 3 moving averages. That's it. All right. Really powerful ones, but they're very powerful support and resistance within the context of a trend. We do not have a trend right now, right? How do I know that? Down here, I've got a very long streak of a yellow signal on the multi-trend. That is neutral, gang, right? That's neutral. And so we have a neutral non-trending market. However, we have a lot of bullishness. That's your momentum on the top row. So trend is the bottom row, momentum's the top row. And we have quite a few green grab, GRAB, which simply stands for green, red, and blue candles, right? So there's bullishness here. It just hasn't organized into an uptrend. So if we think something long enough, then we act in that way, momentum. And then finally, momentum, if it persists, ultimately gives us a trend. And that's what we're waiting on here. But as the ZB futures continue higher, the rates are dropping. Now that's in line. Now remember, bonds love to front run Federal Reserve by about 6 months. This is the ZB for June, right? So these are the June expectations for 2023. So you might say, okay, Rag, if we can look at ZBM, what about ZBU? Can we go out to September? Is that also moving higher? Now it's very, very thin, right? It's very, very thin. So it's tough to go that much further out. But I think it's really worth noting that, again, as this price moves higher, that means yields are doing what? Moving lower, right? So if I go out to the ZBU, so I'm going from the June M contract to the U September contract, it's almost a full point, one handle higher. So as we go from June to September, expectations for where the long bond will be, what the yields will be, they continue to drop. So that's in line with that September expectation for we're definitely getting a cut. So now we're putting more pieces together. All right, what's another thing? What's another symbol that would possibly reflect this potential dovishness from the Federal Reserve? The US dollar, right? Now, the way that I like to look at the US dollar is through the euro. Now, you might ask, why is that? I've been a Forex trader for about 20 plus years. And I think all Forex traders out there know this. The Forex market is the biggest market on the planet by a landslide. And the biggest market is the way the euro trades against the US dollar. So that's just how many euros do I get per dollar, or how many dollars would I need per euro? However you want to look at that, it's the exchange rate. This is the biggest market in the world. Well, when you look at dollar index, DX futures, the UUP ETF, maybe you're looking at the DXY. Remember, whatever flavor of the dollar you're looking at, 58% of it is this thing. This is a high concentration weighted currency basket against the US dollar. So the cleanest way to understand where the dollar is going is look at the most weighted currency in that basket. Kind of like the same way, if we were looking at the NASDAQ, we would give disproportionate attention to Apple or Microsoft because of its weighting. Same thing goes for the euro's place in the dollar basket. Much, much easier and very accessible. So if I just pull up 6E, I'm looking at a futures contract, darn near a 24-hour market. What's the futures contract doing? When a central bank is hiking rates, think of the currency as the stock for the country, it's going to continue to strengthen. When a central bank is expected to cut rates, that's bearish for the currency, and it's usually going to weaken the currency. So what we have here is not only the ECB, the European Central Bank, still embarking on their hiking cycle, strengthening the euro. Traders of the dollar also know that the US Central Bank is almost done. So that's creating this tipping of power, of strength to the euro in terms of value. That's good. We don't need necessarily a really strong dollar reflection when yields are going lower and we're expecting the Federal Reserve to start cutting. We want that to all be in sync, gang. All right. Weaker dollar does not mean the demise of the dollar. Gang, I've been trading currency. I get this a lot. I've been trading currencies for a really long time, and I always get this question: isn't it the end of the road for the dollar? This will be, I don't know how many times I've gone through this cycle of, oh, the dollar's done. I'm not going to comment on that. I do get a lot of that question, though. What the bottom line is if the dollar's done as a reserve currency, something else has to take its place. And just because the dollar is weak doesn't mean it's done. We've seen weak dollar before. And that's just a reflection of a hawkish central bank from the ECB and a potentially dovish central bank here in the US. All right, let's get to it. Now, I would also recommend during non-farm, do not engage in gold and bonds. They will oftentimes expand further past historical volatility. I've given you a macroeconomic breakdown with Fed fund futures. We've taken a look at the euro. We've taken a look at the bond. Now we're going to start trading. Really easy. I don't have to spend a lot of time crunching numbers before I start trading non-farm because I've already got my zones on the chart. So what I want to do here really quickly, if I can, before the data comes out, yeah, we got some time, is I'm going to take a couple snapshots of the way this looks now, because once the volatility hits, what's going to happen is we're going to start to see, did I take the snapshot there? There we go. What we're going to start to see is that all of these symbols are going to pressure their volatility ranges. So whenever we're looking at the Dow, the NASDAQ, the S&P, again, I would recommend to most traders do not engage bonds and gold or even the euro in this environment because they can go way beyond their historical volatility. The S&P is a really good place to stick to, right? You can trade the S&P, ES, you can trade the micro S&P, the MES. So what I'm looking at is where are those zones of volatility? And it's already mapped on my chart. This is an hour by hour historical volatility look at the way in which the NASDAQ typically moves over the past 6 months from 8 to 9 a.m. Eastern. So this is historical volatility, support and resistance. We can further buffer this with, say, volume, right? So here we go. Looks like the initial move is going to be on bonds. We absolutely shot down lower. And this is what I mean about, say, the 10-year note. Here's the 10-year note. It sunk right into that green zone. We're actually an oversold stochastic, neutral environment trying to go red, but yields, gang, I would steer clear of ZB, ZT, ZN, and focus really on maybe NASDAQ or the S&P, whichever one you're really comfortable in. So the first thing we want to look at, and I'm going to show you where this is why we take the snapshot. Anything close to 4,100. Let me show you this here. Anything close to 4,100. Bear with me. I'm going to show you the chart here. Okay. And I'm making sure I got my orders in. Anything close to that 4,100 is going to, see this right here? Right in there. That's the zone we want to be buying in. Oftentimes, I'll place a limit order in that area. Again, this is not for traders who have never traded non-farm before. Please keep that in mind. So you might say, okay, Rog, do we have any directional bias as we start the day? Yes. Are we above the previous session close? What's the structure on the 60-minute? It's up. What is the structure on the 5-minute? Neutral. That's that yellow. What's the most recent signal that we have? Well, I'm using the slow stow right here, right? And the last signal we had was a slow stow going up, right? So this is all buy or nothing. And then all I'm waiting for is for the ES to sink to about 4103, 4110. The closer we can get to that green zone that we saw, the better. Now, the green zones are going to move around once we get the hot zone. This is actually a really sedate non-farm so far, very sedate. So if you're wondering, is this a really volatile one? It actually is not. Why do I know that? See these dotted lines? That's the least amount of historical volatility we could move. That's the least amount. And so having reached something aggressive like that, that would be my cup of tea on a day like today. But we're definitely looking at a buy-only environment. All right, let's do the same thing on the NASDAQ. All right, the NAS is not quite as clear. I would say the NAS would not be a good candidate for this. We were neutral between 8 and about 820. We went red, and then around 825, we went yellow again. NASDAQ would not be a good choice for trading pre-non-farm payroll because we didn't have a lot of clarity before the hot zone. ES, and let me show you YM. This is how important this multi-trend is, gang. Notice I'm talking about the structure of the market before I even get to the zones. This is great. Another oversold stochastic, a neutral environment. That means buy only, right? So we look at those volatility levels for an opportunity. All right. So now that we have, and it is pretty quiet. That's a really, for non-farm, that's pretty quiet. So if you notice, I have no idea what the non-farm payroll is. I don't care initially what that number is. I want to make sure I've got my limit orders in. In this case, I wanted to show you why we had a bullish bias. And then now we'll go take a look. And of course, the sun's right in my eyes. Non-farm payroll in March, actual came in at 236 versus 311. Gang, bad news, miss is bullish. What does that mean? If we miss, it's lower. The impression is the Federal Reserve is breaking the economy with their current messaging and monetary policy. Any kind of miss in data, most especially in jobs, inflation, and in growth, pressures the Fed to knock it off. Now, that's an opinion. Let's take that opinion back to where we started this whole conversation. You remember, we were looking at this before the data hit. Not a lot of change on May. See that? We're still very much looking at a hike in May. This might change again. We're going to give non-farm about 15 minutes to digest. All right. Let's see here. Bear with me, gang. I got to make sure I'm okay. All right. So sorry, gang. I'm actually talking and trading at the same time. All right. So here we have, what are the expectations? June. Wow. This is not the adjustment I was expecting. The adjustment I was expecting is a less hawkish Federal Reserve. This might be a little delayed. The data's only been out for 5 minutes. We'll revisit this before we wrap up this session. Let's go back on over to the Zones. Okay. So one of the questions might be, Rog, what are these zones and why are you looking at them and how do they work? So over the past 6 months, from 8 to 9 a.m., there's a typical number of points that any market, in this case, it's the Dow, will move. And when you look at current price and you project volatility support and volatility resistance, right? When you project those, this is resistance, this is support, right? And we'll get another zone between 9 and 10, 10, 11. So this automatically adapts to the fact that 8 to 9 is not always the same volatility as 9 to 10, 10 to 11, and so forth. All right, so let's look at the same thing on the ES here. All right, and if y'all have any questions, feel free to type them in, or we can discuss them during Charts and Coffee. Okay, so again, I hope everyone sees what was the main point, or what was the main initial point of contact. The lower range, right? We were looking at the lower range, and then the upper range ends up being resistance. And then I would expect, and I wanted y'all to see this because we're really stress testing this thing. This is a very volatile, historically volatile event. It's a historically hot zone, right? So that's my resistance. That's my support, right? And so what I'm looking for, I'm still really not looking at a short. The buy was really the best way to engage this. However, this could be a target. And for those of you thinking, okay, Rod, can we short it? Well, the closer we are to the high here, right? The high on the slow stochastic, the closer we are to the high, the more likely we would look at price as being overbought. Now, if price corresponds with the volatility resistance and an overbought, right, high reading, yeah, you could look at a short. I'm not super interested in a short, but if we're going to fatigue from anywhere, it's going to be that zone. All right, it's going to be that zone. And that's exactly what we're doing. Okay, let's I am curious because I am very tempted to look at bonds. I mentioned to everybody, please don't, if this is your first non-farm or you're not used to trading these, I mean, I've traded, quite frankly, at this point, probably over 100 of these. Please don't engage bonds. Focus on maybe S&P. And this is what bonds are doing right now. But see how we're going negative on the structure? I would be very hesitant. So I've been eyeballing this for a potential buy. I can't. However, those are hourly price movement ranges. Those are support and resistance zones that update every hour. This is a process, gang, that I created about a decade ago. And I covered it in my last book, which I think was released back in, 2010, maybe 2012. No, 2010, I think. And I started introducing this concept of historical volatility to, at that point, Forex trading, because that's where I had the data. And then now, fast forward, we've got this data in stocks, we've got this data in Forex, we've got this data in crypto, we've got this data, lots of markets, because there is a pattern to behavior from us. And every hour does have sort of a repeating probability of a number of points that we're going to move. And so if we understand how to put that on the chart, right? Now we've got a volatility-based support and resistance tool. Probably one of the coolest things I've ever created. I'm biased though, right? Of course, I think my tool is awesome. In terms of buys, for those of you that are wondering, Rog, let's step out a little bit longer term. Does this weakness give us an opportunity to buy, say, bonds on the 1 hour? I would absolutely keep an eye on the 1 hour chart as we go into 9:30. And when we do, if we can hit the 132 handle or wherever the DPMRs are going to be, once we open, this is going to be a long TLT or long ZB opportunity. So I'll be looking for that maybe after the bell. We have futures trading, I think, till 10 Central. I can't recall. But it does. We have a shorter not even a half session really today. I think we close at, is it 9:15? So when we say bell, 9:30, right? 9:30. There is a psychology around that. Obviously, Wall Street's closed. So it's going to be 9:15 Eastern. Oh, that's when so there won't even be cash. Okay. Very quirky day, gang. So either I'm going to get this, oh gosh, all I've got now is about 35 minutes. This might be a Sunday or Monday trade, but I'm going to be with you all on Sunday for the This Week in the Market report, which, by the way, I will, let's see. Oh, okay, the bot has pushed through the link for the trial if you want to try it. Oh, it's a 30-day trial. Wow. Okay. So if you want to check that out, it's in the chat stream. And all right, so there's that. Cool. All right, what about questions? Y'all have any questions? I know I threw a lot at you. But what I really wanted this to be was what is the process before non-farm? Although we could do this before GDP, PCE, CPI, any of these major high heat hot zones. This is the process right now. So we know how and where the information is going to land in terms of rate expectation. We can confirm with the euro. We can confirm with the long bond. We can confirm with ZT and ZN too, the 2-year and the 10-year. It's really up to you. All three would be great to have a fluency in all three of those treasury futures instruments, those symbols. But at the end of the day, it's, you saw, I didn't have to spend 20 minutes trying to figure out where I want to be a buyer or seller. I got to break down what the data means with you all, which is really important. And then I just look at the green and red zones before the data comes out. Those are the hourly price movement ranges. Completely automated, right? Completely automated. Things are going to move fast. I need to know where to put my limit orders to buy, my limit orders to sell, because gang, I'm not market ordering this thing. There's no way I'm going to put a market order on some of these wicks. It's either I've got a limit order waiting there because I have a predefined zone that's already there waiting for me to react to, or I don't. Okay. And that's the morning, gang. That's the morning. So let me tackle a few questions and then I'll take a quick break and I will see you all. And sorry, gang, I keep swiveling my head. So a lot of you know I'm sitting in front of about 9 monitors here. Actually, I am sitting in front of 9 monitors, and I'm just looking at the other symbols that I've got my eye on. And they're all futures contracts, by the way, gang. This time of morning, 8:30 hot zones, they're all futures contracts. Okay. All right. So let's see. What we got here? Hey, Captain Jane, it's, I don't look at this as a day off. There's data. So I have an afternoon and an evening off, but this morning it's pretty important data, and we're going to take a look at the Fed Fund futures again when I see you all in Charts and Coffee, and then yes, we're going to absolutely call it a day. And of course, it being Good Friday, again, I just really don't understand the logic of releasing this kind of data on a day like today, where you're not going to get full participation from market participants. Really quirky decision to release it today. Considering it's a bank holiday around the world, right? So it is what it is. But in my mind, it's my job to find opportunity in things like this and make sure that now we know what the jobs data reveals. When I sit down and write This Week in the Market, I've got this information reflecting in that report. All right. Next up is, Forex Factory has a different number. Sarasota, I'll look at Forex Factory and also Trading Economics, and the consensus can be a little bit different. Yeah, consensus from site to site, you're absolutely right, can often be a little bit different. All right, Dimitri, how are you? ES and YM, red zone, go down, but it was bullish. What about first come, first serve? Yeah, it's the long only. Dimitri, it's the long only. And why? Kind of went over this. This will be available on replay, gang. It was really important to me that everyone who is trying to see, okay, Rog, how do you use these hourly price movement ranges? We're stress testing it in a very, very volatile environment. We're stress testing the multi-trend and the slow stochastic. I wanted to show you all what this is in a sort of a hyper intense environment. Neutral environment, the only signal before NFP was an oversold buy on the slow stow. So yeah, it was definitely first come, first serve at a support level. Yes. So next up is, Will I be no, there's no morning session. Yeah, I wasn't sure if the markets are open until 10:15 or 9:15, but no, there's no morning session. I thought they might be open a little bit longer than they are, but I'll probably make my decisions as to what to do with this come Monday morning with you all. All right. So will I be trading Monday? Yes, absolutely. I will be trading Monday with you all in the Sector Secrets room. Yes, you bet. My pleasure, John. Absolutely. We're going to have charts and coffee. So if you have some more questions, feel free. Let's see here. On the Ultimate Day Trading Strategy course, am I giving my entries and exits, or is it a formation on futures? It's an educational class, Mark. So if you want to know how I use how I set up this process, the whole process, the sequence, the tools, that's what the classes are. If you want to watch me trade and trade with me, that goes on in the Sector Secrets room, right? Okay, so I hope that makes sense. I'm grateful for the time you all spend with me. Are you kidding? Otherwise, I'd be just talking to my cat or dog, and actually neither of them are in the office with me today. So I appreciate it. I'll see you all at 9 at Charts and Coffee. Hope this was helpful. If you're catching this on replay, leave comments, leave questions below. I do check them. And then I'll see you over at the Charts and Coffee show at 9 a.m. in about 14 minutes. Okay, and it is a separate link. All right, it is a separate link. All right, until then.